Welcome to Global Tax Talks Tax in 60 Seconds. I'm Will Morris, and here are some things to watch out for in the coming week. Last week, I talked about what we believe the US wants in order to resolve its concerns with Pillar 2. This week, following more questions, I thought I would dig into the major provisions of the US retaliatory legislation under proposed Section 899, as well as changes to the Base Erosion and Anti-Abuse Tax, or BEAT. There has been a lot of speculation in the media, some of it quite fevered, that this will kill investment in the US, including in government debt. Also, that this is intended to raise significant amounts of revenue. I think both of those are probably a little wide of the mark. Anyway, let me very briefly describe the provisions, although I'm afraid I'll have to use some technical terms, and then give a couple of thoughts. In the case of an unfair foreign tax and the presence of applicable persons, Section 899 will automatically raise the tax rates on certain companies and individuals by 5% a year for up to 4 years, for a total increase of 20%. An unfair foreign tax includes under-tax profits rules, or UTPRs, digital services taxes, DSTs, and diverted profits taxes, or DPTs. US Treasury can also designate certain taxes as extraterritorial or discriminatory. There is an exception for taxes that do not affect US persons or CFCs. This provision would also override tax treaties to impose higher rates, but uses treaty-reduced rates as the baseline. So if a treaty lowers dividend or interest or royalty withholding tax of 5%, the increase starts from 5% rather than the standard 30%, and the same is likely true for a 0% rate. However, it's a little less clear what happens to ECI, or effectively connected income, which is covered by a treaty exemption. Section 899 defines applicable persons to include foreign governments, certain individuals, corporations, including those owned by applicable persons, and entities with connections to certain foreign countries. But it's not completely clear how this applies to foreign partnerships and investors. Additionally, the BEAT would be increased on US subsidiaries and foreign subsidiaries with US operations within foreign parented groups, where there are applicable persons in countries with unfair foreign taxes. In such cases, the BEAT will apply regardless of the thresholds that normally have to be met, and the tax rate is increased from 10% to 12.5%. Importantly, the BEAT can no longer be offset by tax credits. The result is that many foreign parented groups will be brought into the BEAT regime for the first time. So the impact, should this happen? Well, I really do think that this is not intended to raise revenue, but rather to bring countries to the bargaining table to discuss the US asks I mentioned last week. And second, even if this were to apply, it would not apply to US government debt. That was made clear in the committee language in the House of Representatives. But the general rise in rates could be impactful, and some important groups of entities lose prior exemptions. So non-US governments and their controlled entities, such as sovereign wealth funds and state-run pension funds associated with discriminatory foreign countries, could lose their current exemption from US tax under Section 892 on US source investment income. This change could reduce the attractiveness of US investments, especially for those outside treaty jurisdictions. All of that said, it's worth noting that this bill has still to work its way through the US Senate, and changes are possible, though I'd be very surprised if the provision were totally dropped. So it is really important to pay attention to this. Anyway, thanks for joining me, and come back next week so that you stay global tax ready.